You'll find that the news sources and social media are extremely positive when prices go green and extremely negative when prices go red. Are we going to witness a bounce, or are the markets going to sell down? This is a very important question to be able to answer for yourself and by your own analysis. I'll show you how to get started with that. Financial markets may be really daunting, but to get the skills is what you're after. Rely on yourself first and foremost. Learning is earning. Let's run the numbers. Hi everyone, I'm Ken from CryptoTradingKS. If you're new, a very warm welcome and welcome back, KS family. One thing to be aware, the scammers are very active. The only things I'm involved with are these things here on the YouTube About page. Anything else I have nothing to do with. Please be aware of scammers. As we go through this video, I'd like you to keep two things in mind. One is Rule 239, CTKS Structure overrides. And the next one is, there's a 99.9% probability that the Fed will keep rates where they are, and about a 0.1% probability that the Fed will actually ease rates. So that's pretty non-existent. But the concept is there is a 0% probability that they will hike on the 1st of November FOMC meeting. This is important. It's vitally important to track the Tier 1 charts. They're the engine of financial markets globally. And when we talk about tracking, it's total market structure or objective dynamic market structure that you need to track amongst all of these different names. Today we're going to focus specifically on the S&P 500. We're going to look at the NASDAQ. We're going to stack some probabilities by looking at Apple and then looking at NVDA. We're then going to come back to look at the US 10-year yield as well as oil. We're going to finish up looking at Bitcoin. I'll be using the word CTKS structure a lot. It's an important concept to understand. I'll explain it as we go through. The markets pay you for your synchronization, and you'll make losses when you're desynchronized with the market. There's a lot to understand in financial markets. I'll just give you a very quick run through from CTKS News, the Market Analysis tab, on key macroeconomic data releases. We saw the PMI come in stronger than anticipated, and this is really good. It means that manufacturing is picking up. We also saw that the initial jobless claims were higher than anticipated. The Fed kind of likes that at the current time. But we also saw that the GDP numbers were literally a knockout. Personal spending is coming up, and that's a big percentage part of GDP. Personal income was a little bit lower. This would reflect the move to part-time work from full-time work. The important thing, core PCE price index year on year and month on month came in exactly as anticipated. That can create any shocks inside the market, and consumer sentiment was slightly better than anticipated. Financial markets move on data, and when we look at the S&P 500, I'm just going to go back in time a little bit to show you how the S&P 500 on a daily basis was moving. When it was moving down like this, everybody expected an absolute market crash. You can see all of these red days. They just freak people out. But what happened the next day? It went slightly down. And then what happened? It started to bounce. And it literally came back up to this level, almost just retracing. Just pretty much the entire negative move. But what happened then? It started to come down again. And then as prices fell, just especially below this level, everybody thought, oh, it's all over. Price is just going to zero. Calls for 3,000 on the S&P were coming thick and fast, even calls for 1,500. But what actually occurred? We went down a little bit more and then we bounced again. And what's happened recently? We've seen a lot more weakness in the S&P 500. A lot of people right now would be saying it's a surefire thing to short the S&P 500. I'm going to go all in with all of my money and short the heck out of this thing because it's a guaranteed return. The first rule of the first rule of financial markets, there is no such thing as a sure thing. When everybody, that means retail, thinks that it's a sure thing, it's going in the opposite direction. Smart money, the banks, the financial markets do not rely on feelings. They rely on data. We're going to zoom into this particular area and have a look at CTKS Structure. Total market structure, or CTKS structure, is formed through the CTKS method, which is the world's most powerful smart money buy and sell level detection system. Why is it so powerful? Because it marks up all of price history. It seeks to understand where there's confluence inside the main markets. One of the things just recently, we know that the GDP numbers were just bumper. We also know that personal consumption expenditure was better than anticipated. Also, consumer sentiment is improving. What the problem is right now is the war in Gaza. And what we've seen, and we anticipated this quite a few days ago, if the war between Hamas and Israel extends, global GDP growth will be hit. War always unsettles financial markets, but the markets always recover as well. The critically important thing is to understand structure. The structure inside the market right now, there's an enormous amount of smart money buy support at 40.88 to 41.09. Retail would think there's no support at all, it's going to zero. They are utterly incorrect. Just zooming in to the 30-minute view of these particular areas, you can see as price came down to hit that first structural support area, there was so much weakness we got a retest and it couldn't retest again, and it was moving down to the next major structural area. But you can also notice it didn't really dip deeply into this area at all. That's because it's so strong. This video is all about a bounce in the S&P 500. The first tick we get is there's a lot of structural support underneath price. That is revealed through the CTKS method. We now need to stack probabilities. If we look at the chart through the CTKS method, we can see that Apple had very good support at that 171.66 mark, but unfortunately it lost it. If it's not going above, it's going below. And if you've got a fresh air gap followed by another fresh air gap, very low probability of any small structural level holding price. It's going down to the next area of structural support. And we've seen it didn't even tap it. It got very close, but it didn't reach it. This is very positive. We want to see the buyers stepping in at these levels to support Apple. Apple is an incredibly important chart. If Apple comes up, the stock market right across the board is coming up. And we know consumer sentiment has improved. Things can play out really slowly in the stock market. If we pop on the structural levels for NVIDIA, we can see that even though NVIDIA had terrible news, the US curbs exports of more AI chips, including the NVIDIA H800 to China. That did take it down, but where was it going? And we already saw that it couldn't get above this particular structural resistance level at 448.16. If it's not going above, it's going below. Where did that mean the target was? 414, and that's exactly what caught price. It couldn't get above, so where's it coming back to? The structural level below, the 414. But you can note that even though market conditions were very negative on NVIDIA held up quite well, except for the last trading session where it's come down and found structural support. Having this knowledge of where smart money is looking is incredibly valuable to you. We've stacked a couple of probabilities, Apple and NVIDIA. They're bouncing from structural support. But what about the NASDAQ? What is it doing? It's doing the same thing. It's bouncing from structural support, and it's just getting caught on a particular level, 12,640. And unfortunately, that's not really confirmed itself as either support or resistance at the moment. Price is just popping on there. However, this is really good because it's showing that price is slowing down. There's been a lot of fresh air gaps inside the market recently. That's been causing those big spikes down. They're negative fresh air gaps and they're a real headache if you are not prepared for them. But if you're prepared, they can be an enormous opportunity. Before, I was mentioning that the GDP growth had been very, very good. It came in way hotter than anticipated. That means the engine of the US financial market is healthy, even though it looks blatantly unhealthy at the moment. But what about when we put the indicator on for the US 10-year yield? This is important because if the Fed was going to increase the federal funds rate, you can think of the US 10-year as your mortgage rate. This mortgage rate level would increase. And this has been marked up with the CTKS method since 1912. That's about more than 40,500 days worth. What do we see here? It's retesting the lower boundary of all this thick smart money once support, now turned to resistance. It has a negative fresh air gap all the way down to 4.8%. This is a fantastic piece of news. If, for example, the yields start to fall down here, and we can see a similar thing on the US 2-year. This would indicate a market bounce and a rally is incoming at exactly the wrong time for most people who think a crash is coming. We also need to look at oil because oil is inflationary. If oil is taking off, and a lot of people thought oil was going to the moon, why did it stop? I guess we'll need to look at total market structure across 59,000 days. Let's just pop on the indicator to see what happens. We can see that a strong structural level was hit at that 85-84 mark, and there was a confluence of strong structural resistance levels that pushed the price of oil down. We can also note at that 85.19 level, oil has not been able to maintain that positive upward momentum. It's becoming weak. If oil comes down, the US 2-year, the US 10-year yield come down, that is incredibly positive for the main markets. That further enforces that there could be a technical bounce in the major indices. Every major indice that bounces, the components of that indice also bounce. We've seen recently, and I explained this in the past episode, that Bitcoin is starting to realign with the S&P 500. This is really good news because they need to realign. And when we look across the crypto space, Bitcoin has been doing well, and so has ADA. ADA is really coming up. Doge is coming up. Tron is starting to shine in the darkness, but it's not up that great a percentage. And we can see that Solana has been doing quite well. One thing to always note, we must be aware of what Bitcoin is doing because it controls literally every alt in the crypto market. Bitcoin is a bit of a junior. It's only been around a little over 5,000 days. But when you pop the indicator on, you'll see a lot of overhead structural resistance between 35,183 and 36,025. When price was just rallying up, I was making everybody aware before that rally occurred that this strong structural resistance would be a major problem for Bitcoin. What is a problem for Bitcoin is a problem for the crypto market. And what is a benefit to Bitcoin is a benefit to the crypto market. These are just the rules that we need to play by. One thing to be aware of, in order to break through this incredible structural resistance area, typically price has to attract the shorts in and then liquidate them, because this is a mass of smart money sell areas in there, all of different strengths. The concept is, if we get a bit of a dip down, because the markets will, in all probability, dip down a little bit and then rebound strongly. This is a really good thing, because if you believe in crypto, if you believe in Bitcoin, if you believe in Apple, if you believe in NVDA, if you understand their business models, if you understand what they represent, you don't mind buying at a discount. In fact, you really like it. Looking at CTKS Structure is an absolute game changer. You can understand where smart money is seeking to buy and seeking to sell. For bullish momentum on Bitcoin, we need to bypass this 34,433 level. In fact, we may be looking at something like this, price coming up to this level, just testing it, maybe dipping down a bit, converting it to support, and then going for the next one. The next structural support level is at 34,716. If the bears gain control of the market, they would seek to push it through this weak structural support level at 33,799 and seek to retest that and resume downwards. When we look at the main markets, things are actually pointing to a technical bounce and a potential follow through, very much due to the good GDP numbers and also the fact that the Fed is unlikely to raise interest rates. Just keep this on your radar. Unfortunately, inside financial markets, there are a lot of scammers who impersonate growing and large YouTube channels and Twitter channels and Instagram channels, you name it, the scammers are there. They're always the same. They always promise good returns, risk-free returns. There is no such thing. The only thing that I'm involved with are these things. Please just keep yourself safe. And if you receive emails saying, I'll manage your money on your behalf, just ignore it. It is a scammer. Scammers are identity thieves. The road to wealth and success is a long one. So many people want to shorten that road. They want to get the fruit without putting in the hard work of watching the orchard grow. There are others that put the hard work in, but they don't have integrity, loyalty, decency. They soon lose what they actually could have kept. That's why positive excellence is a very important thing to keep on your radar. Also, as an investor and a trader, because all investors are traders anytime they buy or sell, you must have a positive outlook on the markets. You need to be kind to yourself. When you encounter a loss, that's just the market reaching out and saying to you, hey, pay attention. This is a rule that you need to learn. As soon as you've learned that rule, you won't repeat it in all probability. And if you do, you just refine your rule. The focus in all things needs to be learning. You'll see a lot of people flash their wealth around, but humility is far more important. People want financial wealth so that they can have inner and outer peace. You actually can get inner and outer peace right now, and you can work your way towards financial freedom as well. Your learning is your earning. As a community, we always solve our problems with positive excellence. We're always seeking to understand the financial markets better and ourselves better. There's no rush to be rich overnight. Just go slow to go fast. What's important is your understanding, your learning, your knowledge, your experience, and your rules. Therefore, we should start small and scale. Do not ever give your money over to other people to manage. Just gain the skills and knowledge to manage it yourself. As part of the creed, we say all of these sentences because they're powerful. They allow us to look at financial markets with optimism and yet also risk management. Basically, you can think you're either learning or you're earning. If you're not earning, you need to do more learning. I hope you're having a fantastic weekend out there, and Kate and I look forward to catching up with you again in the next video. Bye for now.